First of all, welcome to the top 10 things smart people do to mess up their 1031 exchange. With apologies to David Letterman using top 10 gimmick. We felt it was kind of a new take on some of the material maybe you've heard before, but it's always good to have it reinforced, and that's what we're here to do to help you with. So let me just begin by introducing Beutler Exchange Group. For those of you who are unfamiliar, myself, kind of the team here. So Beutler Exchange Group, Toya Beutler is the owner. Obviously, she's been around doing this work for almost 30 years. She's really one of the top people in the whole country when it comes to 1031. She's an attorney. Like I said, she's really truly the expert and relied on by people all around the country with regards to being a resource. So my name is Mark Adams. I've been with Beutler Exchange Group about 2 years. I'm also an attorney. Prior to this, I was in private practice, primarily focused on business law and doing some estate planning. I have some other experience. I was in the accounting world for a while, worked at some Fortune 500 company tax departments. So I have somewhat of a diverse professional background, but I really enjoyed being here, working with Toya and the group here. We have 7 of us in the office, and it's really a great group to work with, and couldn't be happier. So the next thing I'd like to talk about is kind of, again, what the volume is, what the market looks like right now. So as all of you know, this has been a challenging year in so many respects. With regards to the first, few months of the year, it was smooth sailing, and then obviously everything changed, and April and May were extremely difficult for us here in terms of volume. And all of a sudden in June, it rebounded, and we've had as busy of 3 or 4 months as we've ever had. So the volume is up. It's certainly focused mostly on residential deals. The commercial activity has been somewhat limited, but we are really encouraged with the volume we're seeing. And we anticipate that continuing with low interest rates, and just the demand out there is really, really amazing. So if we were together right now, I would ask, where everybody's from, different locations, what type of individuals we have in the room in terms of their backgrounds and what they're here for. Obviously, we have brokers, we have investors, we have attorneys, CPAs. So a wide group of people who deal with 1031 on a regular basis. And again, that's what we're going to kind of talk about today is some of the challenges and things that we see routinely that cause people issues in 1031. And I guess before I even get into the next part of the actual presentation, I do want to address something that's you probably hear a little bit about or have heard or may hear, and that is the future of 1031 and what is going on with regards to the potential tax changes, if there's a new administration, if there's not a new administration, as Congress turns over, what will 1031 look like into the year 2021 and beyond? Well, at first, at the beginning of the year, we had really looked at the new Biden tax plan and his initial call for the elimination of 1031 and some other closure of real estate loopholes, as he would refer to them. There was some pressure on the other side as well from the Republicans who wanted to enact full expensing for real estate, real property, other than lands. So that would also have a major impact on the 1031 landscape. So that has changed a little bit in light of the pandemic and the decline in the economy, and especially the fact that real estate has really continued to be the engine that's driven the economy for a large part. There's a reluctance to make any significant changes. And even as recently as yesterday, we got some literature that there's been some alterations to the Biden tax plan in terms of not mentioning those real estate changes to the tax code. 1031 is 99 years old. It'll turn 100 years old in 2021. And we are optimistic that it will be around for a good period of time afterwards. Now, who's to say what happens? But that's kind of where we're at. We've continued to fight for the 1031. Toya and I are routinely on calls with legislators, both Senate people back in DC, Congress people, who have either some influence on the committees they're on, and really just trying to educate them about 1031 and how it's not truly a loophole for the wealthy. It's a vehicle that is used by so many people. Our 75% of our exchanges are, for properties that are less than $500,000. So it's not those ultra rich big companies that are utilizing 1031 to get rid of their tax liability. again, it's a deferral. You're really just looking at a timing difference of when you pay your tax. 88% of all exchanges end up later on selling in a non-taxable or in a taxable exchange. So again, it's not an avoidance of tax, it's just a deferral of tax. And again, that's the point we make. And I think some of that education that we provided has been a real eye-opener for a lot of the people who maybe hear about it, but don't really fully understand the benefit and value it adds to the real estate economy. So I'm going to move on to the presentation. So again, top 10 things. So these are 10 things that are common themes that we see people do all the time that challenges us in terms of what we need to do to provide, the services we do as the accommodator, and those things that hinder successful exchanges. So the first thing is, and probably one of the more complicated things, the first two topics are going to be a little bit complicated. So first thing, they think reverse and improvement exchanges are as easy as forward exchanges. Well, as you all know, a forward exchange is fairly straightforward. Let me just admit these people. So forward exchange is fairly straightforward. You sell a property, we hold the funds, you find a replacement property, we send those funds for you to purchase that property. That's really all there is to it. We have documents in place at the time of sale, again at the time of purchase, and we hold those funds in between. That's the role of the qualified intermediary in a straightforward forward exchange. Reverse and improvement exchange are different. So let me just kind of say, okay, there's a reverse, there's an improvement, and there's a reverse improvement. A reverse is where you find a replacement property that you want to buy, but you have not sold your relinquished property, your sale property yet, but you need to buy it. So you really want to buy it. So what we have to do is we have to set up an LLC or an entity that purchases that for you, because you can't own your sale property and your purchase property at the same time in an exchange. So the similar concept of that is the reverse improvement exchange, where you want to find a property and improve it well before you sold your relinquished property. A straight improvement exchange is where you've sold your relinquished property, then the funds are in the exchange. Again, we set up an entity that uses those funds to go buy and improve property. So when is a reverse exchange, something that is practical for you to do? So number one, it really has to be a property that you can't live without, because of the complexity of the exchange and the fact that we actually have to go on title to the property. Buehler Exchange's entity is on title to the property. It's significantly more expensive. So you really have to love the property that you're going to want to buy. Secondly, you have to have enough gain to make it worthwhile. So there has to be gain in the property you're selling, tax liability that you want to defer, that makes sense to go through this increased price for the exchange company, the fees higher, the complexity, the dealing with the different, entities that we have to deal with. So that is the bigger picture of that. So the second thing is the seller won't wait for you to purchase their property. So we always say, Toya's famous line is beg, borrow, or steal the seller to wait for you to purchase the property until your property sells. So we would say, give a bigger earnest money deposit. Do whatever you can to get them to wait for your property to sell before you buy that relinquished property or that replacement property. The next thing is you must have, so when I say we have to go buy it, so we set up an LLC to go buy this property, this replacement property. Now, we don't have the money to go buy that property for you, obviously. So you have to have the cash to buy that property, or you have to have a lender willing to loan our entity the money for us to buy that property for you. Now, the purchaser is obviously the guarantor of that loan, because Buehler's, non-recourse on that, and we don't have that liability. But again, finding a lender in a lot of situations to engage in this type of transaction is very difficult, especially a traditional lender. Oftentimes, people will utilize a hard money lender in this instance to fund this purchase. And then once they purchase that property and the exchange is over, then they refinance into something more traditional. So that's really how that goes. These exchanges are always customized. No two reverse exchanges are the same. And that's why it takes significant planning and discussions with the different advisors, which is why, this is why it's such a common mistake and why it's listed here, and why we always encourage you. A reverse exchange is just not something that's to be entered into, hey, I think I can do this last minute. There takes a significant amount of planning. The other thing is reverse exchanges are very, usually historically we've taken, 4 or 5 calls a week on reverse exchanges. That's really up to probably 10 or 12. Reverse exchanges are significantly more popular right now because the demand of the market. So people get into the exchanges and they're so worried that they're going to sell their property and then go look for a replacement property. And because the market is so hot that they won't find that replacement property. So they think they can take the risk out of this exchange by finding the replacement, doing a reverse exchange, locking their purchase property down, and then knowing that their relinquished property will sell because of the strength of the market right now. So that is really why reverse and improvement exchanges are significantly more complex, and they require planning. I will mention one last thing, because we also getting some calls on this, is people are finding properties that maybe need some work. They can't find that property at that target value for their property. So what they're looking to do is buy a lesser property and then use the difference to make improvements to that property in an improvement exchange. As I explained, an improvement exchange is where you sell, the money and proceeds come in here as they would in a typical exchange, and then we use those to go out and buy the property in your name in this LLC, and then we use excess funds to make improvements to the property. Now, one thing you need to know about this right now is with the changes to the bonus depreciation and some of the tax laws that are very beneficial, you may be able to buy that replacement property and use those proceeds outside of an exchange, use that proceeds and offset the gain by using a bonus depreciation. Again, I'll let CPAs weigh in on that. That's why we'll get to that slide later, why it's important to consult with your CPA, because you may not always need an exchange, especially an improvement exchange with some of the tax changes that are around. So I'm going to look over here. It looks like there's a question I'm going to answer. So the question on reverse improvement exchange: since the relinquished property is the last step, do you technically have unlimited time to improve the improvement property? That's a great question. So the answer is no, you do not have unlimited time. So the deadlines and timelines are the same in a reverse or a reverse improvement, or even an improvement. In a reverse improvement, your deadlines start once you acquire that replacement property. So day one is the day after you acquire that replacement property, and you would have 180 days to make all the improvements to that property before we in that LLC have to deed that over to you or assign the membership interest in that entity. So that is the biggest challenge for the improvement exchange, is that timeline. So if you're looking at making a significant improvement that is going to require permits and or zoning changes or any type of regulatory compliance that goes along with it, or even finding a contractor for that matter, you only have 180 days. So if any of those things need to be lined up while the 180 days is running, it's going to be a real challenge for you to get the value into the ground by the 180th day. And that's really a key point, is the value in an improvement exchange has to be in the ground. You can't prepay for materials and services so you can use all your money before that 180th day. It has to be actually in the ground by the 180th day. So the timing issue on that improvement exchange is very difficult. So, all right, moving on to the next slide. I dwelled on that a little bit long. So next slide, equally complicated and complex, is the partnership question. So again, lots of questions regarding this. So number 9 is they plan to exchange with their share of the partnership or membership interest in an LLC. So 1031 is available only for interest in real properties, and a partnership interest is not an interest in real property. So you've heard the terms drop and swap, swap and drop. Those are all mechanisms that people have used to try to get out of the partnership, because they as the individual want to own the property, the real estate, so they can do a 1031 exchange. Because what you cannot do is you cannot sell as a partnership, get your share of the proceeds, and then go buy a real property. Because when you sold that property as a partnership, that partnership was the taxpayer. And one of the key fundamental points in a 1031 exchange is the same taxpayer has to sell and the same taxpayer has to buy. So that continuity has to be there. And what you really own when you own a partner, when you're in a partnership, you own a partnership interest. You don't actually own the real estate. The partnership owns the real estate. So if the partnership sells the real estate, the partnership has to buy the real estate. And And a lot of people say, well, we're partners, but we want to go and do different things. We want to take our money. So what are the ways that that can be done? Again, advanced planning is critical, because as soon as that partnership lists that property for sale and is on as the seller, as soon as that purchase and sale agreement is signed with the partnership as the seller, you are really enhancing, increasing your risk if you were to do anything after that point by trying to deed out of the partnership. That's what people always ask. Well, can we just deed out of the partnership into tenants in common right before we sell? Well, you can, and people do, but if the IRS ever looked at it, you'd have a significant challenge arguing that you held that property. The partnership has held that property. The IRS would say you have not held that property as an individual in advance of the sale long enough to qualify hold it as qualified property eligible for the exchange. So again, if you want to get out of a partnership so you can sell property, you want to make sure that listing is in your individual names as tenants in common. Same with the purchase and sale agreement. You want to make sure that the partnership has deeded the property out to you as tenants in common. There are, and I won't get technical on this because there are really 11 steps that are, delineated about how to get out of a partnership. And it gets pretty complex, but just a couple of them are obviously you deed out, you have to terminate the partnership agreement, you have to file a final partnership return, you have to execute a tenant in common agreement. And all this needs to be done technically before you even list the property for sale. So if you're planning well in advance, this is all accomplishable, but it is very difficult to do last minute. So again, you really can't wait on these things. So the other thing that I always want to that I do want to mention here, because it's kind of a corollary of this, number 9, is if you have a husband and wife. So if the husband's on title for a property that maybe he acquired before they were married, and now he's looking to do an exchange, but when he goes to buy replacement property, he wants to make sure his wife's on it. Well, because he's selling, he has to be the only one buying. Oftentimes what we can do in that situation, or we'll suggest to people, is that when they go in for the sale, that escrow records a deed, and most escrow companies will do this, records a deed in the husband's and wife's name prior to the sale occurring. So now both husband and wife have sold, and then both husband and wife can buy. Now, the other question we sometimes get is, well, it's a husband and wife LLC, because they decided they own property, they wanted to put in an LLC because they were advised to do so. And now they're selling in this LLC, husband and wife, and this is a non-community property state, so Oregon we're talking about. So husband and wife in an LLC is a partnership, and then husband and wife can't go buy in their individual names. Well, let's say they're going to buy, they have a rental house that's in an LLC that's considered a partnership, and now they want to go buy another rental house, and they try to buy it in an LLC. Well, if there's any lenders or mortgage people on this call, they will know that that can be a real challenge, because here we have a LLC that's trying to get a residential mortgage, and they're just not going to be able to qualify, or they're not going to be able to get that in a traditional setting. So that's always a concern. So what will happen there is that either they'll try to get out of the LLC before they sell, or if they can, they'll just bring cash to the table to buy the replacement property, and without a loan. So, but it is something to be aware of. It's not always the best when you're talking about 1031s and you might be doing a 1031 at some point, to be in an LLC. It's far better to remain as tenants in common, because it gives you flexibility and carry a big umbrella policy to protect yourself in terms of liability. Again, those are just some thoughts. It's much greater considerations than 1031 when people are doing and setting these things up, but it is something to think about. So, all right, moving on to the next slide. Any questions on partnerships before I do? Again, the last 2 slides, we could spend the whole hour delving into all the different scenarios and issues. But again, they're both complex. They both need guidance before you jump into it. Number 8, we get this call fairly frequently as well. So, you sell a relinquished property, you're looking to buy replacement property, it's real difficult, you can't find anything. Wow, why don't I just buy from mom or dad or grandma or grandpa or sister or brother? And the simple answer is you can't. 1031 prohibits you from buying from a related party, with very, very few and limited exceptions. So the only exception, which I'll just mention before I come back to it, is if you buy from a brother or direct relative, like I said, mom, dad, grandma, grandpa, brother, sister, kids, is if they are also doing a 1031 and then will hold that property for 2 years after the exchange. So again, that's very rare for that to happen, but you would be eligible, because the way the IRS looks at it, that is, it's all deferral. So there's no basically exclusion of gain. Where you do have issues and where we do get the calls because people think, wow, this is too good to be true, as if they might be the first person to ever think about it, is, let's say you sell your relinquished property, you're looking for property. Oh, mom owns a house and mom and dad own a house and they've owned it for 20 years. And wow, they could use cash, and wow, they could get the primary residence exemption or exclusion. So I'm going to buy the house from mom and dad. Rent it back to them. Well, they'll have all this cash, so that won't be a problem. Well, the reason that doesn't work is because here you are deferring your gain by trying to purchase mom and dad's house. Mom and dad are selling their house, getting a bunch of cash tax-free because they've been able to exclude all their gain under Section 121, and that just doesn't work. The IRS is not going to allow you to play that game and shift that basis around and make that purchase. So the 1031 does not work for a related party. And as an aside, brokers, they should be working with you to find property. They shouldn't be relying on a relative that they can go buy from. So again, encourage them to find new property that somebody who they're not related to owns. Last thing I will say is that, aunts, uncles, in-laws are not considered a related party. I had a call Monday from a gentleman who was doing an exchange and looking to buy a replacement property, and his daughter-in-law had inherited many years ago property and had significant gain in it, but she was the only owner of that property, and it worked out perfectly for him to purchase that from his daughter-in-law, since she was the only one on title. His son was not, so he ended up he's going to be able to purchase that property because his daughter-in-law is not a related party for the related party rules. All right, moving on, unless I have any questions on that. No, it does not look like I do. So I will move on. Similar type situation in terms of family members. So we get this call a lot as well. Tenant is their daughter and she has been covering the mortgage. Case law has made it very clear that if the property is going to be the subject of an exchange, the family member needs to be paying fair market rent, not just the mortgage. So let's say the mortgage is, there's a place in Northeast Portland and it's $1,800 a month is the mortgage payment that mom or dad owns, and daughter's been paying $1,800 a month, but actually the fair market rent for that piece of property is $3,000. Well, that is not good enough. So the IRS would look at that and say that's not fair market rent, and it's not technically a rental. It's not qualified property for a 1031 exchange. You may not exchange that. So how do you, the next question is, how do you determine what fair market rent is? Well, again, it's like any IRS position or any tax position. How would you substantiate that if you were sitting across from an auditor and they said, well, is this fair market rent? And you said, it is fair market rent, and here's how I got to fair market rent. And you give them Zillow comparisons or other market comparisons that you've come up with. How do you substantiate that? It's really a reasonableness test. If you're close, you're probably going to get the benefit of the doubt. But again, it has to be fair market rent. It cannot be just the mortgage. So I do want to make another distinction here. When you're talking about family member rental of a property versus family member using a property vacation rental. So we get this scenario a lot. So if somebody buys a property, let's say down in Cannon Beach, and their daughter's working down in Cannon Beach and she's going to live there all year long and pay fair market rent, that is truly a rental. Now, if you have a place in Cannon Beach that is a vacation rental, as we all know, we kind of have those rules that vacation rental, limited personal use, the first 14 days the first year, 14 days the second year. Well, if daughter goes down to Cannon Beach and stays there for 10 days because she's having friends down there or whatever, those 10 days count as your personal use. That is very different than a full-time tenant that is a related party. Related party, when it comes to the rental of a vacation rental or second home, counts as your personal use. Now, friends do not. Friends pay fair market rent. Again, that does not count against your 14 days of that vacation rental. But again, there is that distinguishment that where you have the full-time rental versus the vacation rental. So fair market rent is critical in the full-time rental position. So that's all on that slide. So next, number 6, you'll see this tax bomb go off. Tax day was yesterday for a lot of people. So they plan to talk to their tax advisor at tax time. Only the tax advisor knows if the taxpayer even needs an exchange. Oftentimes the person doing the exchange does not. And this is so true that people have heard of 1031 exchanges. They think they need a 1031 exchange. They call us, we start talking through it with them and just giving them the general information that we provide. And they realize they still want to do it, but they need to talk. We suggest talk to your tax advisor. And then we get a call back, the next week, and they realize, and thanks for the information. I talked to my tax person and finds out I do not need to do a 1031 exchange because I don't have that much gain, or I have gain, but I have losses elsewhere that could offset that. So I always say this to people, you really can't look at the 1031 exchange in a vacuum, because the 1031 exchange is just one part of your overall tax picture. It is one form that flows to another place on your tax return, and there's a lot of things that impact that. We can't get into that analysis with you when you call. We can give you general information, we can ballpark some numbers, but we don't have that visibility to your tax perspective. So whether you're working with somebody who's doing an exchange, whether you're an investor, broker, investors, you probably know, brokers, if you're working with clients, you should encourage them certainly to call us because we want to be a resource, but they really need to know what their situation is, because when you're talking about what your gain is, what are you really deferring? Well, your gain is your sales price less your adjusted basis. And a lot of people just don't understand even what that means. So your sales price is pretty obvious. Your adjusted basis is what you bought the property for, plus any capital improvements you've made to that property, less any depreciation you've taken on that. So that's your adjusted basis. And I know I'm oversimplifying it for CPAs out there who probably can give even a better breakdown of it, but that's generally what you're talking about. So your sales price less your adjusted basis is your gain. And then you're going to apply whatever tax rate, your capital gains rate, to that gain. Now there's obviously depreciation recapture. There's some other pieces to that that would impact it. But again, that's the general number. But if you don't know any of those numbers, if you want to do an exchange and you say, have a very small gain, it may not be worth paying the exchange fee and being subject to the restrictions of the deadlines and this taxpayer. You may find better uses for that do not, present the burdens that the 1031 framework does. Utilize it. So again, that is critical. We had several calls over the last couple weeks from CPAs who are preparing these returns for people who extended and whose deadline was yesterday. And somebody called and said, I talked to this person and they said that they ended up not doing an exchange because, it inherited some property, but they wanted to do it. They had talked to another exchange company. Was there any way they can do anything? But the bottom line is they thought they'd inherit property, which they had, and that they got a step up in basis when they received it. But 2 years had gone on and the property had significantly increased in value, and then they sold it. They didn't do an exchange, and now they had a $70,000 tax bill because they thought that they had the step up in basis instead of really understanding where they stood from a tax perspective. And that, again, I can't emphasize that enough, is really understanding where you sit in a tax position outside of just the 1031. Again, you could have losses that you could offset gain with. There could have been potential ways to, offset some of the gain if you took cash out and then you used it to improve the property. There may be offsetting deductions. That's something that people, never really understand, is that there's always going to be taxable items associated with a 1031. Even if you defer all your gain, there are taxable items used. There are taxable items on the settlement statement that are not like-kind properties, so they're considered boot. Again, it doesn't ruin the exchange by any means, but they're just some small tax items. Again, and they may be offset elsewhere with the fact that they're normal business deductions, since this is technically a rental property or investment property that has other deductions against it. All right, moving on. to the next one. So number 5, they call the exchange company when they think they have everything sorted out, or they don't call at all. There are so many exchange rules. Navigating those successfully requires early and full consultation with exchange professionals. This is so true. Again, I think the first thing that I want to say is you must, the seller must have exchange documents in place at the time of sale. So when we say, or they don't call at all, we do get calls occasionally from people saying, I closed on my sale on Monday and I want to do an exchange. Well, unfortunately, that's too late. We really need to hear from people before, because there are things that need to happen. First of all, we need to have all of these conversations. We need to have these conversations so people aren't making any number of these 10 mistakes that we're talking about today. We need to have these conversations so we can tell them to talk to their CPA. But the bottom line is they need to talk to us, because we have to prepare documents. We have to coordinate that with escrow, because that's the normal way our process works. Is once they are under contract, you, the broker, or the client let us know. We reach out to escrow. We get the documents we need to prepare our exchange documents, which then are executed by the exchanger at the time the sale occurs at closing. And then again, the proceeds come here. So we get this question: how much time do you need to set up the exchange? Well, we set up exchanges, within a half hour. We've gotten calls with people sitting at the table signing their documents, and the escrow officer says, what about a 1031 exchange? And they say, what is that? Well, you need to call this company. Well, you got to get documents in place. So we've had to put documents in place in a matter of 30 minutes. That is not ideal. So we really like to have a couple days at the very minimum, so we can get documents prepared and sent to escrow, so they're prepared and they can incorporate those documents in with their scheduled signing documents for their close. If we can have 2 weeks, we really like that, because it makes everybody be aware of what's happening. If last minute things come up, communication lines are open. It makes the whole process smoother. It also allows for people to kind of get a jump maybe on finding a replacement property. The earlier we know and can set up documents, truly the better. But if worst comes to worst, we can do it last minute, but we prefer, and escrow definitely prefers, that we know a little bit ahead of time that you're doing an exchange. Once that sale closes, the window's closed. There's no going back on the exchange. Same thing with your purchase. Once you are, out looking for property and under contract, we'd like to know. Oftentimes we'll be asked to send earnest money. So again, we have to know and have documents signed before sending earnest money on a replacement property. But again, escrow likes to know, and we like to work with escrow and make their jobs as easy as possible. So please communicate with us. You can't communicate enough with the exchange company. Any questions along the way, with you as brokers, investors, clients, you got to call us and ask us the questions, because the communication is just going to make everything smoother and easier for everybody involved. So, and again, regardless if you've done 10 exchanges or this is your first exchange, please call us, because things may have changed slightly, maybe not, maybe not. But again, there's things that you forget, things that, may help you if you just call us and have the conversation. Again, whether this is your 10th time or your first time, we're here to be that resource for you and kind of just make sure the process is in place for you to have a smooth exchange. Next one. Always another big issue and question. People think their exchange deadlines get extended to the next business day. 1031 deadlines are the only tax deadlines that do not get an extension. So again, constant communication about this with people. Your deadlines are etched in stone. That 45 days, 180 days are firm. If it falls on a Sunday, if it falls on Christmas, it's the 45th day or the 180th day. There's no getting around it. So if it's the 180th day and you have to have a property closed, you're not going to obviously be closing on a Saturday or Sunday. So the 180th day then effectively is the Friday before your 180th day that the purchase has to close and the exchange has to conclude. 45th day, there's just no way around it. There's no extensions. The 45th day is final. So what are the deadlines? Maybe I'll just back up. So once your sale closes, 45 days to identify. Generally up to 3 properties is the rule. There are two other rules, the 200% rule and 95% rule. 95% rule is virtually never used. The the 180, I'm sorry, the 200% rule is sometimes used if people are buying multiple properties. And that can be something that we would talk about in more detail. But again, 45 days to identify, 180 days to close on one of those identified properties. Once we get past that 45th day, that ID list is set. There is no changing it, amending it for any reason. I don't care if you can't get a loan now on the property you want to buy, if it has major asbestos problem, it's been purchased by somebody else. The IRS doesn't care. They say once you pass that 45th day, your list is your list. You can't go off it. If you can't buy any of those properties, now you're stuck in the exchange for the full 180 days. You'll get your money back at the 181st day. You will pay tax as if you had at the sale of the property. Now, one thing without getting too complicated here, but I do want to mention it is at this time of year, sometimes those 45th days and the 180th days go over the end of the year, the calendar year, which is then into the next tax year. So sometimes people will sell in one year, the 45th day or 180th days in the next year. They fail to complete their exchange for whatever reason. They then have the option to treat that as an installment sale and pay tax on it in the following year. So if this happened to somebody right now, they may have sold in 2020, but then the exchange ends in 2021, they get their money back, then they're going to pay tax in 2021, so they won't file that return until, or pay tax on that until 2022. So there can be some benefit there, but you have to have a bona fide intent to complete the exchange. It can't be a way to push money into another year. If the IRS ever looked at that, they'd have to see a bona fide intent that you were really trying to purchase property and it didn't come through. Extensions are rare and almost non-existent. That being said, this year we have had 2 extensions in Oregon, well, one nationally and one specific to Oregon. One, we had the COVID extension that was from April 1st to July 15th. So any deadline in 1031 that fell between April 1st and July 15th was automatically extended to July 15th. That was the only one that was issued. There was talk that it would be extended by 120 days like a normal disaster is, but nothing ever happened. So some people got a major benefit between April 1st and July 15th. Some people who sold in end of March and had deadlines towards the end of March that didn't fall within that place, and COVID had just hit, and so they couldn't buy anything, ended up kind of getting the short end of the stick. So there were some people that benefited, some people that they did not. So again, that was one extension this year. And then we had another extension recently, which was due to the wildfires, obviously in Oregon. So that applies to anybody who sold property before September 7th and then had a deadline between September 7th and January 15th. Their deadline was automatically extended to January 15th, 2021, or 120 days after their original deadline. So this benefit, and the reason why everybody that was a client of ours, an exchanger of ours that met that qualified, because if your exchange company, your CPA, your relinquished property, or your potentially identified replacement property was in an affected disaster area, you are eligible for that extension. So everybody that does exchanges with us, because we're in a county that was declared a disaster area, was the beneficiary of that extension. So, but again, if you bought something or sold a property on September 10th, you're outside that window, and so you do not get that. You have a normal deadline. So that's something that happened this year. 2 extensions. The previous year there weren't any. So again, you just never know what's happening in this wild, crazy year. 2 extensions when it comes to 1031. So next slide. How are we doing on time? We're doing okay. So next slide. People are moving too fast when they complete their identification form. Transposing addresses, omitting the city and state, not describing the fractional interest, etc. You see the police car pulling over a Ferrari there, going too fast. So either going too fast or too slow when they complete their identification form. So again, that 45 days, those deadlines are critical. Too fast. So what's a good ID? Let's just kind of back up and say that. So it's a written, signed, delivered within 45 days, and unambiguous. So it has to be in writing, has to be signed by the exchanger, has to be delivered to a party of the exchange, which is the qualified intermediary in most cases, within the 45 days, back to the deadlines, and it has to be unambiguous. So what does unambiguous mean? It means, again, you don't want to transpose addresses. You don't want to just write 123 Main Street with no city or state or zip code. It doesn't have to be the legal description of the property. Generally speaking, an address is good enough. If there's no address, a parcel number that adequately describes the property is good. But you really don't want to mess up your ID form, because if in the event you were audited, IRS isn't auditing 1031 exchanges, but you were audited for another reason, and the fact that you did an exchange came up. One of the first things that the state or the federal government, IRS, would look at is they'd say, please show us your identification form. And you'd want to make sure that it was, again, met all of these 5 criteria. And if it did, and the ID was good, most of the time, and then you acquired one of those properties, most of the time, that's the extent of it. You're moving on. That part of the examination from the IRS perspective is over. So again, the ID form is critical. You don't want to go too fast. It's a document that is important. And so we want to make sure that it's completed correctly. And we're really not going to be, the exchange accommodator it's not our role to review it for accuracy. If we notice some major discrepancy or some significant omission, we will point that out to you, but we can't be responsible for the accuracy of the information provided. We'll acknowledge we received it on time, but that's really the extent of what our obligation is in this scenario. Again, we'd answer questions about how to do things and whatnot, but when it comes to the actual review of this form, that is not our role. So the next slide is, people think that if they sell a rental house, they have to buy a rental house, or if they sell a commercial property, they have to buy a commercial property. That is just not the case. Really the best rule in 1031 is the like-kind rule, and what qualifies as like-kind. And this is really very expansive. It's real estate held for investment, business or rental purposes. So we do get this question a lot. Hey, I'm selling a rental house. Do I have to buy a rental house? No, you can buy whatever you want. Any type of property that is income producing. So you have multifamily, you have office buildings, you have bare land, you have, triple net properties. So those are all, a DST, is Delaware Statutory Trust, is something that we see a lot of recently. And that's a fractional interest that qualifies as real property. And I can get into that more, but that's a little bit more detailed. So, but you do have to look at all of these options because they're all out there. So if somebody sells a rental house and they want to exchange the land, here's just a common question, and it's fairly general knowledge, but I'll just reiterate. If you exchange from an improved property into bare land, that is like kind, it works. Now, you do have the issue of depreciation recapture, meaning if you've taken depreciation on a rental property and you exchange to bare land, you will have depreciation recapture, because the 1031 has 2 benefits. One is you defer the gain, but the other is you defer depreciation recapture, unless you exchange to a property that does not have a way to be depreciated, which bare land does not. So you would then have depreciation recapture. So improved property to land works great, but you have to know what that depreciation number is. And the only way you're going to know that is from talking to your CPA. Back to that old, repeated trope on that. So, but again, all these things qualify for like-kind property. The DST, again, is a fractional interest that is, you're buying a small interest in a big piece of property that's generally handled through a financial advisor and a sponsor company, and something that is very popular. It's passive income, but it's also something that you don't have to worry about once you're invested in it. It gets you out of that active management of real estate. So that is that one. The next one is, and the number one reason, I wish I had the bravado of David Letterman is going to his very last one. The number one reason is they think they just have to reinvest their cash, at which point Paul Schaefer would bang the drums. But that being the case, people call all the time and say, hey, I'm selling a property. I'm going to have $200,000 worth of cash after I sell it. And they omit to tell us they have a mortgage. That's all they think they need to reinvest. That is just not the case. 1031 requires the full reinvestment. To defer all your gain, you have to fully reinvest for what you're selling for. So you have the sales price, less obviously the realtor's fees, our fee, escrow fees, whatever that number is, that's what you have to buy at or above to defer all your gain. It is not just the cash. You have to replace debt in your at the time of your sale, whatever your debt is, you have to replace that. Or you do have the option to offset that debt with cash. So you can replace debt with cash, but you can't replace cash with debt. So there's no way to sell a property and you have $200,000 in the exchange, and then you say, okay, my target is $300,000. I'm going to take $100,000 and put it towards this property, and then I'm going to buy at or above. I'm going to borrow $200,000. So now I'm buying for $300,000. So I've met my threshold, and now I have $100,000 cash, non-taxable. That is not the way it works. You still would have taxable boot coming out of the exchange because you have to use all your cash, and then you have to replace your debt. And the reasoning behind that is, the 1031, I guess, history is that 1031 is an incentive for you to keep your money invested in the American real estate economy. So if you have $500,000 invested in the American real estate economy, whether that's all debt or all equity or part debt, part equity, the incentive is to keep that you're going to get that deferral is to keep $500,000 invested in the American real estate economy. So that is how that works. The typical case that we see is, again, people think they only need to invest their cash or only invest their gain, but it's really that full amount. 1031 is not a way for somebody to get debt free. It's not a way to sell your property, take your cash, buy another property, because and then just forget about the debt that you paid off at the time of your sale. If you do that, you will have the basically income on the cancellation of your debt. So you need to make sure you replace debt. People get, Toya has a lot of great stories about this. People get more mad about this than anything in all these rules that we've talked about. People get mad. People will call and yell. People will call, and not necessarily at her, but about the rule that they have to take more debt on when they buy replacement property. They have to replace that debt. They don't understand it. They think it's unfair. They think, that the government's just making it difficult on them. And that may be the case, but the bottom line is you must replace your debt in a 1031 exchange. Again, you are able to bring in cash to offset that debt. So if you had $100,000 worth of debt that got paid off when you sold the property, and you don't want to get a $100,000 mortgage on the new property, but you have $100,000 cash outside of the property, outside of the exchange, you can bring that in to offset that debt dollar for dollar. And that's a way some people do get debt free, is they have the outside cash to bring in and offset that debt. So, okay. Now I do have a couple questions. Okay, so do you ever have anyone pay down debt prior to doing the exchange in order to limit the debt requirement? Well, that's a great question. In fact, if people have the money to pay down the debt prior to the sale, so then they don't have the debt requirement, people do that. We always would encourage people, and the IRS is actually taking a little bit of a closer look at that. What we would say is, if you have that cash, let the debt get paid off through the sale, and then bring in that cash to offset that debt on your purchase. That way you are in the same position, but now you've just offset the debt on the purchase rather than you paying off the debt prior to the close of the sale. It's an easier way to do it. And frankly, the IRS looks more favorably on it being done that way. So next question is, if you sell a property for $500,000 and pay 5% in real estate fees, do you have to buy for $510,000? Or can you buy a property for $485,000 to qualify for the 1031? So that's a good question. So if you sell a property for $500,000 and pay real estate fees, what you'd be basically your target would be, and I'll kind of go over what the target is maybe this will help. So your target price, your target replacement property value is your sales price less your realtor's fees, so less that 5% realtor's fees, so $25,000. Less escrow fees, whatever those are, and less our fee, whatever that is. So that's just the general number that you're going to want to replace. Again, the other way to do that, frankly, is whatever proceeds are in the exchange plus whatever debt was paid off at the time of your sale is your target number. So that sometimes is an easier, cleaner way to look at it. Cash in the exchange plus debt paid off at the time the sale occurred is your target number. So that's how you're going to defer all your gain. Again, the question also says to qualify for the 1031. So you could certainly buy property for less. That's the other thing that I do want to mention. It's called a partial exchange. So if, like, let's say your target number in this case is $485,000, but you find a great property for $450,000, go ahead and buy that property for $450,000 because you are going to have a good exchange. It's partial exchange. You're going to pay tax on the difference between the 450 that you bought for and your target number of 485. But if it's a good buy and you think it's the right property, who cares? That's a good partial exchange. It makes sense. It fits with what you're trying to do. So don't get hung up on that number of, oh, I got to be at 485. This property isn't going to work. I got to be above it, because there's going to be ways possibly for you then to offset some of that $35,000 in this case worth of tax by maybe going in and doing some improvements and then, you know, expensing them against that gain that you'd have coming out of the exchange. Again, remember the whole picture. 1031 is important. You got to follow the rules to have a good exchange, but you got to look at the whole tax picture. And with all the rules that are changing constantly, you got to have that input from your tax person to help you maximize the value of the 1031. What is the current accepted holding period for an exchange property before you can safely convert it to a primary residence? Great question. So the current accepted period, I'll give you two answers. First is, if you have a full-time renter in the property, in your replacement property, for 1 year, we think that after that full year of rental, you have exhibited the intent, the requisite intent that you have, that when you purchased that property, you had the intent to hold that indefinitely as a replacement property. So 1 year if you have a full-time renter. Now, if you have a vacation rental or second home that you're limiting your personal use at, before you can turn that into a primary residence, you have to wait 2 years. That is it's the only time frame that the IRS has really even given in revenue rulings. So they have said the safe harbor is 2 years. So if you have a rental property that you're VRBOing, that you're using 14 days first year, 14 days second year, and then you want to make it a personal residence, you got to wait the 2 years. Full-time renter, 1 year. Part-time rental, you got to wait 2 years before moving in and making it a primary residence. So those are the only questions I have. So, and that's brings me to the last, well, we're at the last slide. So, and we're at about 9:55 in the morning. So again, we want to be a resource for you for questions. Whatever questions we don't get to today, or as you get out there and you're working with clients or your own personal situations, that's really what we do, is we want to be the 1031 resource for you in this market. So please don't hesitate to reach out to us at any time. That's what we're on the phone all day, talking with people, explaining rules, going over situations. It's what we enjoy. It's what we try to make it as easy as possible for everybody to get through their exchange with their full knowledge of what they're doing. So we have a checklist on our website. We have, our website is also a good resource if your clients are interested in learning more before they call us. Certainly point them in the direction of our website. We may do another class. Toya may do another class before the end of the year, or at least certainly early in 2021. So keep your eye out for that. Again, I apologize for the confusion this morning with regards to the 8:30 versus 9 o'clock starting time. We'll get that squared away next time so people aren't jumping on too early. But again, I apologize if it disrupted anybody's morning too significantly. If you need real estate credit for this class, please email us at the email address here on the screen, team@Buehler Exchange. Looks like that's spelled wrong, Exchange Group. Don't copy and paste that. It's BuehlerExchangeGroup.com. You can find that on our website as well. Include your name, license number, contact information, and we will get out a certificate to you within the next month or so. So that is all I have for this today. Again, thank you very much for taking time on this Friday morning, the end of this last quarter of this tumultuous year. We enjoy working with all of you and appreciate all your business and calls and friendship over the years. So continue to stay engaged with us, and we'll do the same with you. So thanks very much, and have a great day, everybody.